Welcome, everybody. We appreciate you coming. Taking a look at 2017 in review, it was a record-breaking year for us. We had great margin expansion, cash generation, record sales, and we have very positive momentum going forward. We just met at the World of Concrete, which is our major trade show, at the end of January. We set record levels for attendance, both domestically from the U.S. and internationally. And it's amazing how positive and excited all of our customer base is about the business that they have ahead. In the process of doing this, we've made some changes to the dividend policy, and John will tell those to you as we go along the way. And we're looking at this year as the fifth year of our projections, and we're quite confident in the fact that we're going to meet our projections of $90 million in the 5-year plan. And with that, I'll turn it over to Howard to give you some of the highlights.
Great, thanks, Jack. One thing, Jack, I want to add to is we identified a new market segment, which is the high-rise structural market, which we're not currently in. We've been into this sector for about a year now. We have some development improvements, so we're anticipating a late fourth quarter launch or early 2019. So we're very excited about this new opportunity. As Jack mentioned, we had a record year last year, ending at $85.6 million, which is up $6.2 million over 2016, 8% growth. We had 4 of the 6 regions perform above 2016. Europe was 53% growth rate over 2016. Our ride-on screed sales grew 29%. Our 3D sales grew 11% last year. And we had 2 new products last year, the 158C, which was introduced into China, and our SP16. Both products about $870,000 in revenue. With the amount of growth opportunity that we're seeing in Europe, we're moving to a new facility late in the second quarter. Just kind of breaking it up into territory, North America grew at $1.2 million. We had a very slow first half, and we picked up momentum in the second half, and the second half was 10% greater than the first half. Europe, as I mentioned earlier, 53% over 2016. China, like the U.S., was off to a slow start in the first half and grew 7% in the second half. Middle East, we had a great year in the Middle East at $2.1 million, selling into Saudi Arabia, Dubai, Jordan, and Qatar. Latin America, good pickup last year at $2.3 million, 35% growth. The rest of the world, some notables in the rest of the world. India, we had $745,000 compared to $100,000 in 2016. A couple of things we added in India, an extra salesperson, and now we have an in-country general sales manager on board. So we're extremely excited about last year and excited about 2018. Breaking it down into categories, we have boom screed sales were basically flat over 2016. And to give you an idea, one machine is $430,000. So you can see a big swing one way or the other. As I mentioned, ride-on category up 29%. Remanufactured machines were basically flat over 2016. 3D sales continued to be strong. We had a total of 66 units compared to 61 in 2016. And our parts and accessory sales are about 15% of our sales revenue on an as-going basis. And with that, I'll turn it over to John.
Thank you, Howard. So Howard talked about the top line, which grew 8%. Importantly, that translated well into growth and profits. So our EBITDA grew 14% to $28 million. That's a 55% EBITDA conversion, which is really driven by some operational leverage as we had effective cost controls on our operating costs. The other profitability measurements were also very strong. Profits before tax, adjusted net income per share, all up in that 15 to 20% range. So we feel really, really good about the translation to growth and profitability. Equally important is the cash flows were quite strong. Our quality of earnings remain very, very healthy. Operating cash flows grew 16% to just under $20 million, which allowed us to pay nearly $14 million in dividends in 2017, retire all of our bank debt of about $1 million early in 2017, fund all our CapEx plans, as well as settle stock options and RSUs of a little bit over $5 million. So we did all that with our operating cash flows and ended the year at a net cash position comparable to the prior year end at $19 million. And with the overall financial health of the business and the confidence in the outlook, we recommended an increase to our ordinary dividend per share payout ratio to 50%, which the board approved. That resulted in an increase to our ordinary dividend for 2017 to 15.5 cents, per share, which is a 40% increase year over year. And we also recommended the adoption of a supplementary dividend policy, which is a measurement of our year-end net cash position relative to our intention to maintain a target of at least $15 million in net cash at year-end, with a plan to distribute 50% of that excess cash out to shareholders. That translated into a $2 million supplementary dividend, which is paid in, alongside the final dividend in April of this year, or 3.6 cents per share. So overall, really strong financial metrics. On slide 6, the operating results, a couple of points to highlight. Gross margins remain very stable. We're comfortable at the current levels. It's just a tad under 57%, 56.9% for the year, and we feel comfortable at this level. On a go-forward basis, we're not really looking to expand gross margins, but we think they're sustainable where they are. As I mentioned before, we had really good operating cost controls, which helped translate into the growth in EBITDA. Particularly in the general and administrative and support functions, we did a good job of leaning out some of those expenses. On a go-forward basis, as Howard mentioned, we have some new product initiatives underway. We do expect to spend more in the SG&A area, particularly driven by investments in engineering and product development. So we're looking to spend on an incremental basis of about $1.5 million to $2 million total increase in SG&A, which will cover the normal growth of the business, wage inflation, commissions, et cetera, and allow for some targeted investments to support the new product efforts. Importantly, obviously there's been some changes in the tax laws in the U.S. While in 2017 we had a 28% effective tax rate, the effective rate for taxes going forward for us, we expect to be about 21%, which is the new corporate rate in the U.S. We have a very small foreign tax deemed repatriation expense we expect to incur in 2018 of $750,000 or less. But aside from that, our tax rate should be about 21% going forward. And then lastly, capital expenditures were down to $2 million in 2017, a little bit closer to our true run rate. Most of our building projects have been completed. We do expect to spend about $1 million in run rate CapEx to support the business. Plus, we do have a planned expansion of our Fort Myers footprint, which we're currently reviewing, of $1.3 million. So this year's CapEx would likely fall in the $2 to $2.5 million range. Balance sheet, we talked about the cash position. Working capital has remained in line. We had a slight uptick in accounts receivable at the end of the year, which was really driven by some year-end, very strong trading in the U.S. and in Europe. Those balances have since been collected, and the balances are reverting back to more normal levels. But overall, we feel comfortable with the working capital management. And on slide 8, the cash flows, as we discussed, the strong operating cash flows really support the investment plans and the financing activities, particularly dividend payments. And we do expect cash flows to benefit from the tax law changes, which should be a meaningful impact to our cash tax payments in 2018. The dividend policy that we adopted, this is just a representation of the ordinary dividend, which is a payout ratio of 50% of adjusted earnings, up from 40% previously, and the supplementary dividend. Our philosophy on the dividend is that we want to maintain a disciplined return of cash to shareholders. We don't want to incur excess cash balances on our balance sheet at any point in time. But our first priority will be, and continue to be, if we have opportunities to reinvest the money back in the business, which generates a very strong return on investment, in our opinion, that will be our first priority. But absent those opportunities, we'll continue to distribute cash under this method. The tax law changes, we talked about briefly, the 21% effective tax rate going forward. One element that's not listed on the slide is there are some loosened capital equipment purchasing expense rules in the U.S. under the tax law, which should encourage corporations to make quicker investments into capital equipment such as our machines. So while we don't think that grows the pie necessarily in terms of our market opportunity, it should encourage faster investment in equipment as part of the tax law change.
And with that, I'd like to take a little look at going forward. We're very optimistic about this year. And that optimism comes from the feedback from our customers. We do have a direct sales organization worldwide, so we're constantly in contact with our customers. And we ask them where their business is coming from, how strong their bidding process is going ahead. Are your margins getting stronger? How many signed orders do you have? What kind of commitments do you have? And it's absolutely amazing how positive everybody is. And for all of them, it's as positive as they've ever been in their life. And we got to say that, this is as strong as we've ever seen the business. And it's a fantastic time to be involved in it and going through the process of not only growing the existing business, but as Howard said, we have some exciting opportunities for new products going forward. So with that, we'd be more than happy to take any questions you have.
The margin on the new products, is that consistent with existing margins, or how's that working?
Our expectation is it'll be similar margin profile. We're still very early on, and we're kind of viewing this new product initiative as a very long-term effort to get into a new segment. But everything that we understand about that market segment is there's a very strong value proposition. We believe there's going to be a strong payback on the investment in equipment. So we think we absolutely can maintain margins consistent with what we currently are on our.
This is the high rise you're talking
Yes,
about.
structural high rise.
And generally, we do look, whenever we bring a new product to market, our target is to maintain the current margin profile. That's kind of our internal target, and there's nothing to indicate that we won't get there.
Could you talk a bit more about the structural high-rise product, and just in terms of what the market opportunity is and what?
Well, it's hard to gauge the market opportunity, even in the market we're in today, but we do know that there's a lot of buildings going up instead of out because of real estate constraints. And this is globally. This isn't just in the U.S. or Europe. This is all over the world that there's opportunity for us in that market. As John mentioned, very compelling value proposition. Same as it was when we came into the flat work business, slab on grade, is that we save men, improve productivity, and improve quality. We can do the same thing in the air as we do on the ground today. So very good opportunity for us.
So there's no competition in that space at the moment?
Absolutely not. This is net new, innovative, just like the laser screed was when we introduced in 1988.
So are you having to develop new machines specifically for this?
Yes, this is going to be a net new machine. We can't utilize the equipment we have today, which we have 11 different types of laser screeds. We cannot use that on deck because of the weights, the way they screed. So this is a whole new process. Still screeding, same thing we do today, but a different way to do that process.
And when are they expected to come to market?
Well, we hope the end of fourth quarter, early 2019. We're in the testing phase right now. A lot of things happening during the testing phase, but everything has been very promising.
And the way we think about it is, this is a new segment. There's a lot of complexity to the job site environments as you go vertically. So we believe, our intention is to take the first step into that market segment, in the coming months, and then from there we'll learn more about what the portfolio could look like. But we do know, as Howard said, it's a greenfield opportunity, and we're really encouraged by the dynamics of it in terms of the value we can provide.
Is it the same customer base?
No, totally different customer base. So there may be a few of our customers that do structural high-rise, but this is a net new customer base for us. So we're looking at new customer base, new sales team, new support team.
Is it reasonable to expect a large part of that market is in China?
Actually, the way we think about it, we see a lot of it in the developed world. So the U.S., Europe, and our intention is to start there. We do view it as a global market opportunity, but our intention is to start with the solution, in our core markets, which is the U.S. and Europe, ultimately Europe, and then from there, kind of decide how we're going to expand. Right. There's a lot of work to do, and getting traction initially in one of the developed markets will certainly help our case for global expansion.
normally when you started a new market, you tend to establish the demand and your capability at home, which is in the US, right?
Correct.
So you do that first and then
Yes.
expand.
Yeah, we see if there's a need. And what we've done early on was pull a council, a bunch of contractors to do structural high-rise, and we put them together in a think tank for 2 days. And what we wanted to do is try to figure out, is there an area that we can help them? And at the end, they said, yes, here's where we need help. And the ROI and what we can do to save them is huge. So, we're not just thinking of this on our own. We gather our customer base, non-customers, and try to understand. That's why we have 11, 13 products today, is because of feedback from our customers. They're the most important. We're a direct sales team worldwide. We see over 300 of our customers every single month. And we ask them those questions, like Jack mentioned before, how busy are you? How's work look? Are you backlogged? All this information is very important. In addition to that, we say, is there anything we can do better? And they give us some ideas. We take that together, put it in front of our engineers and product development team and say, look, here's some feedback we got from our customers. Here's some improvements, which we've made a couple of improvements to our existing products last year. So we take pride in getting information from our customers and trying to understand their needs.
And that's part of, to Howard's point, I mean, our product development efforts have always been customer-led and just driven by working closely with our customer base and understanding their pain points and figuring out ways we can help provide a solution. And this is no different. In terms of the process, the one difference is that it happens to be a different market segment than we've been operating in up to this point.
The original S240, the first machine that came out, was designed by a contractor because they seen a need. They needed to get higher quality. If they wanted to continue in the business, they needed to improve quality and try to figure out how to do it with less men, because concrete work is very difficult. I was in the industry for 25 years. I know how difficult it is. So they had to find a different way to do it. And then the S240 was born in 1988.
So do you view it as Somero 2, almost, in terms of the scale of the opportunity?
It's hard to tell at this stage. There's no statistics on high-rise buildings or even on commercial buildings. So we've been more focused on developing the product than we have in trying to define the marketplace at this stage, because if we don't have a product, it doesn't matter how big the market is. So we haven't got around to trying to define the market so we can communicate it to you guys. It's an excellent question. It just isn't part of the priorities at this point. And certainly as we get towards the end of the year, it will be, once we're exactly sure what the design and the capabilities of the product are, then we can start. We've been doing prototyping with the council that Howard has. So we actually built one product and it didn't work. It worked on slab on grade, but then when we got on the upper decks, it wasn't right. So we developed, you make variations of it. You know what you're trying to do. You know you're trying to screed. You just don't know how you're getting the screeding mechanism to the top of the concrete. So this is a different design from the original one we have. And so as we work our way through it and find out how to overcome all of the minor issues you have, then we get to the point where you stop and you say, okay, we're going to fix the design, and you go to build it, and then you work on the marketing aspects of it.
You're a really good company. You must have actually worked out that there must be a market.
We have worked it, yeah.
Yeah, absolutely. We try to define the market before we even go to the product development team and say, look, here's what we're thinking. We spent a lot of time, of course, in the US, in Europe, Vietnam, China, Australia, to see where the opportunity is. And I can tell you, because I was there in all those countries, there is a demand for this type of equipment in structural high-rise. Everyone is looking for a better way to improve the quality, reduce the manpower, and increase the production all around the world. So there is an opportunity for us. We just don't know the total magnitude of it.
Yeah, you're looking for his question is geared to a statistical answer that says it's 25% of slab on grade. We know there's an opportunity there because of the council.
You know, I guess we're confident there's a market there. We're confident it's meaningful enough to justify our efforts. What we really haven't done is say, what is an exact number of the addressable market? That for us kind of remains to be seen, and we view that as a long-term effort because there's a lot of differences in terms of the different challenges in all these different high-rise situations, and it's likely not best. It's not going to be addressed with one single product. There'll probably be multiple variations, and we're not quite sure, how long it's going to take to get there. But we know that we're confident enough. There's enough there for us to proceed.
How long have you been working on it as a concept?
We started the whole project over a year ago.
Okay.
Yep.
And if it comes to market Q4 19, how long will it be before you actually start getting revenue from it?
We would anticipate that certainly in the first quarter of doing it that we would generate some revenue. But that's part of the process you don't know about. When you develop a product that's a total invention and you go to somebody and you say, I got this thing, works great on your high-rise building, you want to buy one? And the guy says, no. He says, you bring it over to my building and show me it's going to work on my building. So there's a whole introductory phase where you have to prove to people that this does deliver the value proposition. And so that there's a whole process there we have to work out. Maybe you do a demo at one person's site, but then he doesn't want his competitors to come and see the machine. So those are all the pieces that we have to work out in the early parts of this whole process.
Which is very similar to what you have with the screed machines that you currently have.
In the early days of the Somero family, they had to go around with this 19,000 square foot machine and bring it to Howard's job site and prove to him that it worked before he'd buy it.
And we do the same thing with, as I mentioned before, we have 13 products, and some of those we have to go out and do a demonstration. Not the large line, because we have a lot of good penetration, but the smaller line. And, in each of our products is a different market within, or a different segment within the market. So, same scenario with the screed structural high-rise. Same thing.
So how long do you, based on your experience with the screed machines, how long before it makes a material difference to revenues for this? If it comes to market Q4 19, when do you foresee, will it be a year?
Well,
2 years?
You'll certainly get some revenue in the first year. If you sold 10 machines, that's a significant number of machines. That might yield $1.5 million. So in terms of the percentage of your current revenue, it's not. But in terms of introducing a brand new product, that's a pretty significant start to things. Right. And then you get momentum out of it because you go to trade shows, people start talking about, hey, did you see the new machine? Yeah, my buddy tried it out. So there's a momentum that gets generated by it. Yeah, think of all the inventions you've seen in life. There's not many inventions that the first time they come out, all of a sudden things go through the roof. Apple phones are a little bit of the exception rather than the rule. But how long did it take people to adapt to computers and various inventions that have come along? And that's typically the pattern that we see.
Just think that, back at the 158C and the SP16 I mentioned earlier, that was almost $1 million in revenue for the first year. So that kind of gives you an idea what we're hoping for.
In terms of dividend, is excellent with the supplementary dividend. But for UK private investors, then we have to pay a lot of tax and all this, exchanging dollars into pounds. Is there any merit in share buyback?
So our basis are, we've explored it, and our determination to pay dividends was based on shareholder preference. So, when we talked about having sort of excess cash to redeploy to shareholders, being an American company, our bias is actually share buybacks. And that was our recommendation. But, the vast majority of our shareholder base has a very strong express preference for dividends. And, and so majority rules in this case.
Are you talking withholding tax?
No, I'm just different
tax.
ways of giving back the money to shareholder rather than just one.
Right.
I thought you might be a clever chap to maybe explore.
Well, down the road, obviously we'll always keep the door open to explore it. We're not going to say we're never going to consider it, but right now dividends are what we've gone with. So.
I'm with the dividend. You're a dividend.
So.
Just this sounds like a lot of marketing and development spend in the next 18 months. How is that going to impact results for 18?
So, we don't, I think really most of the spend that we're anticipating is incremental, is going to be bringing some engineering expertise into our organization that we don't currently have, because some of the technology is kind of foreign to us in terms of our core products. As far as the marketing and sales, we're not expecting a major. When you think about our company, we're not a big marketing spend company. Most of our sales efforts were direct sales. It's kind of feet on the street. It's direct relationships, and that's basically a investment in people. So there will be some element of adding some sales team to focus on that area, but that's not a sort of massive investment. That's more finding the people that are tied into that segment, the concrete pumper world, and make sure that they can come on board. We'll train them up, and then they'll go at it.
So you don't expect to see?
No, we're not seeing a big marketing, and sales spend directly related to this, but there will be incremental spend for sure, because it is a separate customer base.
And you've retained enough cash to manage that? Yes.
Yeah, and I think our the bigger area of spend is going to be engineering and in that area.
Can I ask another question on a different subject in terms of the Chinese market? Because that's always been the big next thing over the horizon. Is this now going to replace China as the big next thing, or is China still the big nenext thing, or an additional thing? How are you seeing the Chinese market developing for you?
I think we're pursuing both. I mean, obviously, China, we have spent a lot of time trying to understand the dynamic in terms of the adoption of quality in the market. And the quality, segment is where we play.
Yeah.
That's who we are. We've had really good success initially in China in terms of capturing that space, but it's grown at a much slower pace than we expected. Much of the early growth in the quality segment has been driven by multinationals coming in, building, companies that demand certain quality standards. We've seen less of the domestic acceptance for the domestic development projects. So, we're going to continue to push that, and we think in the end it will grow, but the pace of growth has been slower. So we'll continue to work that as a lever of growth, but we're also pursuing product
Because I've
development
noticed
too.
there's a Chinese local competitor that's popped up in recent years.
Sure.
Yeah.
There's a lot of knockoff machines, and most of those machines are geared towards customers who aren't focused on quality. They're more focused on
They market
Productivity.
themselves as a value option. basically.
Sure.
Yeah, they're in the
Exactly.
productivity side of the market.
Yeah. And that's our value propositions is more than that. So we try to have enough relevance in that space to get new customer relationships into the family. But our where we become profitable and where we're successful is to take the customers that want to grow their business into become a quality service provider that's recognized as one of the industry leaders. And we have examples of that, success cases, but we're working to get more of them.
But you've been saying it's quite slow in China for a while. We've had this discussion last year. Is it because of the knockoff machines, or is it because they don't worry too much about, although they're massive development, they don't worry too much about having level floors? I mean, what is the problem?
Well, I mean, at the end of the day, it's really the pace of growth of building owners, tenants, and users demanding a high-quality floor is the ultimate gating factor. The knockoff competitors are not winning there. It's just that particular market segment hasn't grown at the pace that we would like it to see.
So is it therefore that one hears about massive construction in China all the time? And the answer is that the quality of construction is not as high as it might be.
It hasn't caught on at the speed that it did. Before we came to China, everything was poor quality. So we introduced quality to the country. And that's been true of every country we've ever been in. Before the Someros built the machine, the quality in America was terrible. And in each one of those countries, that they adapt to that new quality standard at a certain rate. And we thought that China would adapt to it quicker because of the number of multinationals that came in. And they have adapted to it, and they believe in it, and they're very anxious to get it done. It's just not working at the speeds that we thought it would.
And is it the locals who aren't taking it up rather than the multinationals?
In general, the multinationals are, but that's one of the projects we're working on now is to get to the locals and put a council of them together and find out why is it that you're not copying the multinationals, because you can get more money for building your building, renting your building. And that's the part of it we're trying to unwind.
Can I ask about the opportunity in India? I mean, is that one likely to develop faster than China? Or, I mean, you've had a good start, it seems like. Or
Well, yeah,
a steady year,
we're definitely heading in the right direction. We have 2 salespeople on the ground. We just put another person there last year, and of course, we got our general sales manager in country on the ground there last year. So we have, in essence, 3 salespeople on the ground with 1 support. Quality is definitely a concern in India, and they accept quality and they want quality. One thing that's really holding them back is the infrastructure, getting the material to the job site and be able to pour, like Jack mentioned, wide placement. But laser screeding is accepted there. We have 46 customers in India today, and in many ranges of our equipment, mostly the mid to small line. But they do accept laser screeding. They want laser screeding. They want to improve the quality and the productivity of their floors. So yes, India is very well in tune to the quality side of the market.
But in terms of the opportunity to grow it,
absolutely. That's why we're investing in people and putting feet on the street. Absolutely.
You say mid to small line. Is that therefore, is it the multinationals there again, or is it local market? Because it doesn't sound as though they're wanting huge machines to lay trading floors and stuff like that. It sounds as though they're wanting rather smaller stuff.
Right, they do, because the multinationals in India can't build the big warehouses in general because you don't have the highway infrastructure to transport things. So it is a lot of the smaller design. I mean, in India, there is virtually no refrigerated warehousing. It's better than 50% of their fruits and vegetables rot because they can't be stored. And that's the whole push for infrastructure there. And as that continues to come along, and unfortunately, when we started looking at India over 10 years ago, they had told us a lot of these large roads would be in. The road from Mumbai to Delhi would be in. You know, it's done by a Japanese firm that's investing their own money. So that part of it is slowing down some of the growth. But that doesn't slow down the desire to have quality, so we end up getting it on smaller buildings.
You mentioned at one point a $5 million cost for share options.
In 2017 that we settled. It was stock options and RSU settlements in 2017. So at this point, we pretty much, those are primarily related to some legacy stock option grants that had a 10-year vest and expiration that were coming upon expiration. The holders of the options exercised those and we settled them for cash. At this point, we pretty much have no options outstanding. I think as of year end, we had 17,000 options total outstanding. So that was a one-off? As a one-off, yes. Yeah.
Talked about very positive current trading. What sort of forward visibility do you have? Do you have an actual order book for your machines? I don't know what the lead times on some of your machines are, whether you just hold.
Howard has a funnel that he keeps where he's constantly looking at where prospects are, and he's got a 12-step plan. So he knows people that are in the category of where they should be ready to buy. And so that gives us some degree of visibility. In terms of building, we look at a lot of historical, in other words, this month, last year, how many of these particular machines did we sell? And we build those machines. Remember, it's rare if we sell 10 of any one thing in a month, so we're talking about small volume. And that way, when the customer tells us that he's got his financing, and that's what we need to have proof he's got his financing. A lot of times he needs the machine in a week or two. So we do keep a certain amount in process.
Usually 10 to 20% flowed in from the previous month, and the rest of it, the sales happened within that month. From a signed order to ship, usually 3 to 5 days, depending on what type of machine. So we don't have a lot of inventory. I think our turns are around 4.
Yeah, a little bit less than 4.
A little bit less than 4.
Could I ask one question? There is excellent rosy picture that you painted. That's very good. But my understanding is a cyclical industry you are in.
Yes.
I think you mentioned last time the presentation I was in is 2008 or some financial thing is
That's
macro
correct.
economy, and then suddenly all
That's correct.
stopped. So this could happen again if there's a big crash all over the world.
Yes, absolutely.
Yeah.
So you can't see really around the bend. It's not up to you anyway.
No. And to be honest with you, we've gone through two of those, and I'll be around for the third one, by the way. Now, if they have anything to say about it, that's a different story. We have not been able to see them in the past. We know when they get there. For anybody that was a shareholder back at that point in time, they'll tell you, we were the first ones to come over here and say that something's happened in the marketplace, and we did a restructuring, and people looked at me and said, "You're crazy," including our bank. We see it. We also see the pickup. And if you look back to our 2012 in January, we told everybody that it was a stronger than expected December because we saw the pickup start. So, but unfortunately, well, think of it this way. If I could predict when that's coming, you think I'd be sitting here? I'd be out writing a book.
But what I'm trying to get at is that do you have any measures taken to minimize any?
Sure.
Yes, we have.
For example,
Keep it cash.
you gotta keep it cash. Right.
There's a few things. So the difference between where we are today and where we were in the financial crisis, we're debt free, or we have a strong net cash position. So that's number one. We have increased our diversification on a product basis, having a much broader product line, and on a geographic basis. So we have a lot more diversification than we did back then. And we've continued to maintain a pretty high variable cost structure. Most of our costs are tied up in our personnel. And as painful as it is, you have to make adjustments when business conditions require it, and we're able to do so. So we think we can manage through that. And if you look at in the worst of it during the financial crisis, we maintained positive cash flow and positive profitability. And we're confident we can manage through any climate.
Your venture capitalist or private equity or whatever it was that sold you, loaded you up with debt before
Correct.
they put you on the market. Is that something that you are not going to allow yourselves to become indebted? You have got lots of cash.
Yeah, that's that. Yep.
Right.
We maintain, part of our adopting the dividend policy, in going through with the board, we did a lot of modeling and consideration to all different business climates, and determined maintaining a net cash position of at least $15 million was very conservative, very sensible. That would allow us to maintain our dividend payout ratio of the 50% in any climate, and would allow us to have more flexibility to make decisions to retain key talent and not make kind of short-term bad decisions that would impact the long-term of the business. So, one of the hardest things we've had to do as a company was build the team we have and get all the experience we have in the building, and we don't want to lose that talent, when things start to fall off. So we have more flexibility now to manage through that, and we have no intention of adding debt to the business.
Can I ask a boring question about the weather? So obviously last year you were impacted in North America by the weather. I'm assuming the weather, I know it's been cold and it has been snow, but has the weather affected you this year, or
This year is normal.
this year's normal,
Yeah,
so we should expect a
it's
pickup from
normal,
that? And in terms of the benefit of the lower tax rate for your customers, or in terms of being able to invest more, when do you see, have you started seeing effects of that, or when would you expect to start seeing the effects of that?
I think the issue with obviously the lower tax rate affects a lot of our customers directly, which is great for their cash flows, and the capital equipment expensing rules are obviously potentially a positive for us. The reality of it is, I think most of our customers and a lot of companies are still trying to sort through what the tax laws actually mean for their business. And typically our customers don't really think about taxes till they get to the end of the year, and they call their accountants and try to figure out what they're...
Oh, so you don't pay tax on account in America for it?
You'll make estimated payments through the year, but the reality of it is most of these sort of tax management strategies often happen towards the end of the year as it becomes more clear what the potential tax liability is. So we would expect any sort of impact of this wouldn't be seen until the end of the year.
Fourth quarter.
Yeah.
Can I ask you about your manufacturing? You said how your order per machine is very low and order visibility is low. So if you get a lot of orders for a particular type of machine, is your manufacturing fully flexible? How flexible is it, and how does that affect your gross margin and your costs?
No, we're just an assembly operation, so all the manufacturing is done on the outside. So we have long-term purchase orders that bring in a certain amount of product. So if for some reason or other you end up with, we built 8 for the month and we need to build 11 or 12, we're only 2 weeks away from building the extra ones. And so it's not a major issue for us. And we are pretty good at following the busy months. We have a lot of history. And so we know the general small, soft months of the year, for example, like January, because of the weather in the wintertime. So we're able to bring our assembly process up and down to do a pretty good job. I mean, it's very rare that I don't think we've ever had a couldn't meet the customer's order.
No, and it really won't impact gross margins. And we maintain enough sort of raw material inventory to account for some shifts in mix. And like I said, we're kind of a low inventory turn, 3.5, 4 times. But being a high gross margin business, that's not a big dollar investment in inventory. So,
can I ask, you are such a big, small company, relatively speaking, and then your ambition is almost worldwide and all this. So how do you tackle this? You mentioned about the exhibition. Do you get a local partnership or franchisee, or how do you do it?
No, we do everything with our own people. I mean, there's a few places in Europe. We have a number of agents that help us with the translations, and we do have one agent in Australia. But no, anything we're going to do for a trade show or we're calling on a group of customers, we do it all with
everything's direct.
Our technical support people and our training people are direct and our sales people are direct. And we think that's a critical part of the company because it's there that all the ideas on how to improve come from. They come from your customers.
But that means you're not outsource anything. Everything is in-house.
Yeah, we control it.
Yes.
And which makes us different than a lot of OEMs in that there's a high level of customer intimacy. We're directly connected to them. A lot of other OEMs are dealing through channel, have a little bit less of that direct contact.
Can I follow that up? Because last year you told us that you were having a very soft first half. But I remember you saying that you actually thought that you were going to have a much stronger second half. And you were really, you had a wonderfully strong second half. But how were you able to tell us so early on that you actually really, you got it completely right? I mean, how
We're that good.
Well,
that's what I really want to understand, about just how good your antennae are.
That's an excellent question. You saw what I just said about we came out of December strong and we had good feedback and we saw the momentum. We had the exact same thing a year ago, December. We had a very good end of the month. We had a lot of good positive feedback. But all of a sudden, we saw hesitation in signing the orders. And we're sitting there saying, what in the world's going on? And then you turn on television every night and you see the whole state's underwater. And Howard talks to the sales guys and they're saying all the jobs that are in process are being pushed out a month or two. And so it was that part of, it's not always easy to confirm that bad weather is for bad sales, because the first thing you do is blame it on the salesman, right?
And he does. And he does.
But no, in all sincerity, we were a little bit surprised by it, but as we sat back and looked at it, we said, everybody we're talking to says there's tons of business, I've got the orders. So we knew we've had this happen one or two in the past 20 years that we've been here. And that's exactly what happened. It started to open up as the weather dried out in certain locations and you get more into springtime. So,
and the second half opened up and the floodgates, we couldn't ship equipment fast enough.
So when you look forward now, obviously your antennae are excellent. It's as you say, you're very strongly linked with your customers. And so when you look ahead, what does it look like?
looks like a very strong year. Very, very good. You know, as Howard said, in our experience, it was a normal winter. There's lots of cold weather, there's lots of snow, but there's nothing abnormal about that. And we think it's going to be a very fine year, and that we're going to have good growth.
One thing that Jack mentioned, we have a trade show every year in the U.S. Which this year was in January. We had one of our best years in 10 years. And this is a selling trade show. Customers come there and sign orders. We had our best show in 10 years. And also attendance was up. So you take all those things in consideration. You sit down with customers and say, how's this year look? They say, well, we're really busy. We have work all the way out to the end of the year. Some say we have work going into next year. Most say they can't find labor, which is great for us because our equipment saves labor. So all those positive things start coming into play. Then you hear that Amazon, everyone's heard of Amazon, is building 8 new facilities through the U.S. So you put all that together and say, okay, and then sales start coming in and you're over and above the previous month or previous year. And that gives us a good sense of the momentum in the marketplace.
But where does that leave you in Europe? Because Europe has done very well.
Oh yeah. I mean,
how sensitive are your antennae in Europe?
Same thing. We're a direct sales team in Europe. As I mentioned earlier, Europe was 53% growth over 2016. And we're seeing a lot of customers get busier, which they trade in their machine or they upgrade to new technology or they're adding to their fleet because they need more than one machine or more than 2 machines. We're seeing that all across Europe.
Another way to look at it, too, is the U.S. has finished 6 years of recovery. Europe has finished 3 years of recovery. So in terms of comparing the two, you have many more years of recovery in front of you. Thank you all very much. Great questions.
Yep.